record it, and then I'm going to introduce myself. Hello, everybody. I'm Roseanne Bump. I'm the Executive Director with FEI Twin Cities. Thanks for being here for another virtual session. We have Eide Bailly with us this morning. So I am actually going to turn it right over to Chad. So Chad, welcome. Thanks for being here.
Good morning. Thanks, Roseanne. Good morning, everyone. And Roseanne, thanks for the instructions on Zoom. I've been literally on 100 of these meetings. I think I just picked up 3 things. So
great.
Thanks for that. Yeah, no, I'm happy to visit this morning about succession planning, exit planning. I work with a lot of clients. I'm the director of our business valuation group at Eide Bailly. Get a chance to work with a lot of family and closely held businesses and help them navigate through all the complexities of exit planning. A little bit about Eide Bailly. We're an accounting firm, a national accounting firm. I think we're 19th largest accounting firm in the nation. And our footprint is throughout the Midwest and into the Mountain West, and now recently out in California. So we get a chance to work with exit planning with businesses and business owners throughout that footprint. And again, I think this is always an important topic and something that you as either advisors or part of the management team that advises business owners should kind of keep in mind. It's a process that is very, very important. I think especially right now with the pandemic, I think there's disruption within a lot of different industries that maybe that's accelerating some succession plans, maybe it's deferring others. But I think very important to be looking at that right now and working with those business owners. So I just want to kind of go through a few slides. We can talk. Please interrupt me at any time with any questions, comments, and we'll talk about them. But I want to start with kind of a little bit about some demographic information on what business owners are looking at right now. This is a study, owner readiness report, published by Exit Planning Institute, right in the Twin Cities. Most recent report published was 2017. And this just shows that more than 80% of business owners are over 50 years old. So we know those business owners are going to need to exit sometime soon. Many of them in the 70 plus category would be sooner than maybe some of the younger, but high need for succession planning. And most of the businesses in this study are not really, really large companies. You can see there's a few that are over 100 million in revenue, but most are small, mid-sized businesses, over 80%, less than 25 million. We know they're ready to exit because in terms of surveying them, over 50% said that within the next 5 years, they're going to be looking at an exit. And finally, just an important context or concept for a lot of exits is that they need to stay profitable and generate cash flow. So in those situations where the businesses sell to a strategic buyer, maybe they're purchased based on revenue, maybe they're purchased based on market share, those things. But we know most small businesses may be sold to a buyer that needs to fund the purchase through the cash flows of the business. That could be an ESOP or a family transition, could be a management buyout, those things where the owner needs to get paid over time and funds really come from the business. So an important part of successful transition for small business. So just wanted to throw those statistics at you and really stress the importance of working with business owners on this. But let's back up a little bit, talk about what does an exit plan look like? What are the various components? And when we talk about exit planning, we talk about creating a holistic plan for that business owner. And that includes a lot of things. First of all, what everybody thinks about right away is generating a really high sales price for a business owner. And that of course is part of it many times, but even before that, I think we need to understand what are the business owners' objectives and goals, because it might not always be top dollar. Several other steps here. We need to understand, other assets the business owner has. We need to understand how to help that business owner increase the value of their business, who the buyer is, and then integrate it with some other planning. So we'll go through many of these steps. And I think the first one, again, is the most important. Too many times clients have come into my office and said, I want to be done in 6 months. What can we do? And then you always want to say, well, we wish you could have come in 3 years before that. and we could have done a lot more planning. And certainly a sale's possible in 6 months, but if it's family transition, if it's ESOP, if it's a lot of other different things, it really helps to have a lot more time. So the sooner we start the process, the better. And then I think another important thing that I'm going to talk about a couple times throughout this slide deck is just who the buyer is greatly changes the strategy of the plan. So we'll talk about external buyers and what a process looks like for those. But then we'll talk about family, employees, those, and how a process looks very different for those buyers. And then the last thing here is a lot of times we'll work with clients and we'll do some financial planning, and we'll work backwards in the process. We'll say, how much cash flow do you need for retirement funding, those kind of things. And then we'll look to the value of the business, and we'll try to back into a plan in terms of making sure they get what they need to be comfortable. And this is one of my favorite parts of succession planning to talk about, and that is really just understanding owner objectives. I've made the mistake too many times of assuming top dollar is what they're really about. And so many of the businesses, I think this is more prevalent in the Midwest, that's not really what they're most interested in. They've built a company, they've built the culture of the company, created some opportunity for employees. Maybe they're a big part of a small community. These are the things they care about more. And when we go through a process, make sure we understand that. It might not be a sale to a large strategic company. It might be something where they reward employees for their loyalty and helping them build a business. And so, again, don't assume that top dollar is the main priority there. I think it's important always to look at the value of the business. And many net worth statements of business owners, that business might be worth more than 80+% of their net worth. So they have a lot riding on monetizing that asset. And of course, I mentioned I do business valuations, so I want to plug the idea that you go out and hire a professional to value the business. Selfless promotion there, but it is, like I said, especially in those cases where it's such a high percentage of the owner's net worth, we need to understand what that's worth and how to monetize it. So just a few things in terms of what to look at when we're selling the business. So a lot of times people jump into right away looking at revenue, EBITDA, cash flows, those kind of things, and rightfully so. Those will drive the value of the business. But also, I like to start with thinking about the management team, especially in an exit where that business owner, and maybe they're 100% owner, they started the business, they've driven growth. What's left when they leave? And so big focus on management team. Many of you are part of that management team. And so make sure you go back and tell your business owner how important you are and that I said so. But it is truly important to have a deep management team. Other things, just operating systems, making sure that business has repeatable processes, that the new buyer is going to be able to step in and it's going to be a seamless transition. Does diversified customer base, I'd add diversified markets, products, those kind of things are also important. Some of these are kind of obvious, having a well put together facility that's updated with equipment and those kind of things. Realistic growth strategies, effective financial controls. I can't tell you how many times deals have paused because the financials were bad or not timely or those kind of things. And so many of you can help with those kind of things. And then just making sure buyers can understand what is the cash flow generated from this business. So a few things to think about. I'm not going to dig into this too much, but I mentioned how important it is to understand who the buyer is going to be on any transaction. And starting with a third party, almost always in those kind of cases, you're really trying to get top dollar and you're trying to accelerate the payment of that. And so many times because of synergies, strategic advantages, you really that might be your best chance to get the most proceeds. I'd say in those situations, make sure you have a good team, whether that's some kind of a broker, sell side team, attorney, accountant, appraiser, those kind of things can really help in a process like that. And that might take different forms, could be going public, could be just a sale to a third party. Hopefully it's not an orderly liquidation, but we're probably seeing more of those with COVID-19. And then there are some unique recapitalization things with minority shareholders and raising money that way. So much different than selling to family members, employees, whether it's formalized in an ESOP or it's just a management buyout. These plans typically require some kind of seller financing. Maybe that owner needs to get paid over 7 years, 10 years, those kind of things. And that, again, a lot of times employees don't have a lot of cash to put down on a purchase. And so they're relying on distributions to help them pay the owner. And you might say, why would I sell to an employee if I need the business to be successful and I lose control? Well, there are ways to kind of keep control of the business until maybe a big chunk is transferred at the end. And maybe at that time, you can get some bank financing for those employees or things like that. So there are ways. The structuring will be very important in those kind of situations, and certainly the owner will take on more risk. But for all those reasons I mentioned before, that owner might want to still proceed in that fashion. And many of you work in businesses probably that have done that in the past. Just a couple more things in terms of process. Make sure you're looking at business continuity planning and buy-sell agreements. I can't stress how important those are. They'll have valuation mechanisms in there. They could have life insurance proceeds if the owner passes. There's various different triggering events covered in there. So if there's a death, divorce, disability, all those kind of things can be covered. Too often I work in a litigation context for those businesses that didn't have a buy-sell agreement. And of course, shareholders can argue about the business value and how to get paid and those kind of things. So make sure you look at a buy-sell agreement. Then the last point is that this succession planning for a business owner doesn't exist in a bubble. There is, estate planning and other kinds of lifetime and death planning tools that should be looked at as you go through this process. So that's a lot to cover in a short time. I'll just mention that, the importance of this is critical. What a good succession plan looks like is that it's one that will first deal with the emotions of a succession plan. And we could talk about that a long time. But as I've seen these fail, it's been more about the readiness of the owner to think about what are they going to do in the next chapter of their life. Are they ready to not show up for work the next day? All those things. It's not as much about tax savings and all the cool little spreadsheets I prepare about value and taxes and those kind of things. It's more about the emotions of, are they ready to turn over this business? But it's certainly something that takes time, and it's something that a team needs to commit to, because there's lots of chances for it to be put aside. And it oftentimes does get put aside, and there's reasons for that. This is, forces the owner to think about their mortality, and they're oftentimes busy running day-to-day business. This is of high importance, but sometimes low urgency. And, having good advisors, good management team to help stay committed to the process, I think is very important. So just some parting thoughts here, and would love to kind of, with this group, get questions from you and hear any kind of challenges you guys have seen with succession planning. But again, a very important process, oftentimes gets put aside. But these business owners need help. We can see that in the demographics. We know the process can be complex. So anything you can do to help commit to a process, understand it's emotional, make sure you draw that out of the business owner to force them to kind of understand that they need to be ready for this. And then, put a good team together and stick to the process. So that's succession planning in a nutshell, and love to hear some questions from all of you.
Chad, this is Mary Kurth, and one of the questions I have or have seen is at least a time frame in which the owner who has sold the business continues to stay with the business. And either from a shorter term perspective, helping with management transition, that kind of thing. Or I've also seen long term where the former owner has an office someplace in the building that they can come on a regular basis. So can you address a little bit about pluses and minuses of that owner continuing to stay with the business for a period of time?
Yeah, it's a great question. I think that the single best way to minimize risk in a buyer's mind is for that owner to stay on for a couple of years. Now, I think that's very attractive for a buyer. What I see in practice is that that owner only ends up staying around 6 months or a year, that it's too hard for them to take orders from a new buyer or not have outright control. And so they do everything they can to help transition client relationships, some know-how, those kind of things. But I find both parties kind of end up ready to be done with each other by the end of the first year or so. And that obviously personality would drive that and will be different for every situation. But I think, you know, your point is great, that if an owner is willing to stay on, and that's why we need to start this process a little bit more than when they're ready to be out the door, it does minimize risk in buyer's mind that customers are going to leave, that employees are going to leave, and can help get a better sales price and get a deal done.
So Chad, what does the market look like right now? Is it a good time to sell? Is there a lot of buyers, a lot of sellers?
Yeah, I hope that question would come up, and I'm going to tell you that I have no idea what to think of valuation multiples. I've certainly talked to a lot of people, and we're not able to necessarily observe a lot of market data. We know public markets and where public markets have gone, and we can probably use those, especially for some of the larger businesses, and to understand where multiples have gone. Certainly there's more risk, volatility, and risk are bad for multiples. And so we do think that, you know, that's going to be reflected, but it's still a strong M&A environment. And I think there are various reasons for that. There's still a lot of business owners that are especially now ready to be done. You know, this is a lot of stress. If I was thinking about being done in the next 5 years, after getting through this, I might be ready to be done right now. And if I can still get a good multiple and get a good deal, why not take it now? And we know that buyers still have cash. They have strong balance sheets, and private equity groups have money to deploy. So we think the M&A environment's still going to be strong. It's going to be challenging to value businesses. I think that, you know, projections are going to be relied on a little bit more. How fast do you get through this time? Public markets are going to be relied on more. And for some businesses, the balance sheet's going to be more important. Maybe goodwill's dissipated a little bit, and we got to look to the balance sheet for the hard assets. But it's certainly going to be a challenge. And I think the good news is that we'll still see transactions. And even in the public markets, multiples have held pretty well. Even as we get earnings reports and things like that, the market hasn't overreacted to that, knowing that hopefully future growth can still be there.
And we did have one question in our chat box. I don't know, Chad, if you saw that. What is different about the selling environment now with the pandemic?
Yeah, I think so. I think some of what we just talked about addresses that. I think you know, other things might just be the challenge of closing a deal in the pandemic. So fortunately, virtual data rooms and stuff were already pretty prevalent in conducting due diligence. But, you know, buyer meetings, management presentations might just be more challenging people to do more of that virtually. Probably with some businesses, you still got to get there, kick the tires, and practice social distancing while doing that. I know even at the accounting firm, we had loan file reviews and stuff that people always did in person. And, you know, we're challenging them to figure out how to do it virtually, and seeing a lot of efficiencies from that. And hopefully you guys are in your business too. There's some things that just won't be the same, and face-to-face is absolutely needed, but we're really challenging people to try to do as much as they can virtually. Have any of you been through a succession recently, or at all for that matter, and have any wisdom to share?
Well, I guess, so my father sold his family business about 2 years ago, and to a private equity group. And a word of wisdom, I guess, on that one is he was able to be out immediately, like that was an option, where there was another company that group also picked up at the same time, and that owner was required to stay on for a certain period of time. And I suppose it depends on the owner, much like you said, and the emotions of that. But I think my dad was very happy to be scot-free of it, you know, all of a sudden just kind of be able to be relieved of that stress all in one piece, and had met with that other owner not long afterwards that was still being kind of dragged through and had no control and no decision-making power, but yet was required to be part of the company, and found that to be quite challenging.
Mm-hmm. One of my first succession plans, maybe 10, 15 years ago, was a smaller company in the Midwest here, and they were grooming somebody to take over the business, and it was probably a 20-person professional service group, and had groomed this person for 3-4 years, had made a lot of promises to them, had really worked with us to come up with a fair price. We put together a plan. We really thought it would benefit both sides. We were very excited about what we put together, and really noticed up until the days leading to the closing that the business owner and his wife were really, kind of quick to, they were very agitated by some small things, and would nitpick at things, and then kind of came to the closing and really kind of got him more than what he asked for. And he couldn't sign on the dotted line, and it did not play out very well. The buyer decided to open their own shop, take some employees. There was a lawsuit about intellectual property theft, and just was a disaster. And really, at the end of the day, they said they weren't ready to say goodbye to the employees or the customers. They didn't know what they were going to do with them. We had never once talked about those things. We talked about the numbers like accountants do, and what a learning lesson that now we start with. Are you sure? Are you ready? What are you going to do with your time? What are the most important parts of this? Who are the best buyers in terms of meeting your objectives? And so it was a good lesson to learn, but really a war story that I'll always remember.
There was one more question, Chad, on chat. So are there particular industries that will be more challenging than others?
I think anything that has that key person dependence. So smaller businesses typically do, right? If somebody started a business and they really haven't delegated or leveraged their team, and then they're ready to exit and they're what's left to buy, that's always something to watch for. And then, of course, right now, anything hospitality business or anything that's really struggling, it's, again, maybe there's somebody interested in your market share or your revenue base or something, but those industries are going to have a tougher time right now.
I have a question. Just how much of the M&A stuff right now is by private equity versus just kind of, buyer to seller individuals?
Yeah, that's a good question. I don't have any statistics on that, but I think it always, anytime we work with private equity, they always have a very specific target profile that they're looking for. Might be 2 to 5 million in EBITDA, might be manufacturing in this region. So for some businesses, I think there's a really good fit, and private equity can be a great opportunity. There's always some horror stories with private equity, but I think most of the time they're really a lot of times hands off, and maybe they're going to have requirements in terms of oversight, but want you to keep doing what you're doing, and just want to be the capital behind it. And maybe turn it over at some point. But I think private equity can be a great option. So can strategic companies. I know there's always some concern about that too, competitor or whatnot. But again, we're seeing more ESOPs, so there's so many different directions you can go.
So, Chad, I do have a question. How often are you seeing owners hold on to the real estate portion of their business, but let go of only the operations?
Yeah, I find buyers are a lot of times flexible to do either, and it depends on the owner. A lot of owners like the idea of continuing to hold some real estate and having some rental income. Some may want to liquidate and become more liquid. So it almost feels like in half the deals, I see them keep the real estate and lease it to the buyer, and the other time they sell both the business and the real estate.
Chad, could you talk a little bit about ESOPs from the perspective of when does an ESOP really make sense versus other options?
Yeah, I'm glad to speak to that. That's usually the first question when we talk about ESOPs. And we used to say, you got to be a certain size. And we'd say maybe your market, the value of their business should probably exceed $5 to $6 million, because there are some administrative costs, not only to form the ESOP, but for the ESOP to run every year. You got to get a business valuation. You have to have a trustee. You have to have all those things. And so if you're too small, those administrative costs can be too burdensome. But if you're growing a lot, and if you have a good employee base, and maybe you bet on yourself a little bit and say, well, yeah, we might be a $3 million company today, but in 5 years we're going to be a $25, $50 million company. And so I think that's an important consideration as well. But there's really a lot of advantages for an ESOP. There's a lot of tax savings that can be achieved that can more than wipe away the administrative costs. So I think if you have a good employee base, sometimes we say if you have 50 or more employees, that's a good rule of thumb. But if you have a good management team that wants to grow the business and be business owners, that's a consideration sometimes more than size.
Then we do have another question on chat here. So it says, and it might be more of a comment. We were recently in the preliminary stages of a transaction. We shared a ton of financials and tax info, agreed to terms, and then hit the due diligence phase. It was overwhelming how much information we needed to create and compile, way more than I expected, and it exposed plenty of shortfalls in our ERP and reporting systems.
What a great comment, Phil. Thanks for sharing that. It's almost like if so maybe that didn't have the outcome you wanted, but you almost want to challenge clients to prepare for a sale, even if they don't have one around the corner, because it does expose shortcomings, and they all will ask for all this information. It's an exhaustive process, the due diligence phase, and a lot of times we're at fault for that a little bit too. We're helping the buyers and insisting on receiving some of that information. But yeah, just to have the systems in place to get the reports you want, because if you don't have that, not only will the buyer be concerned about not having that information, they're concerned about your systems, what they're buying, how they're going to fix this, what kind of investment do they need to make in adding to that ERP. So I think like a mock, nobody would ever do this because it would take so much time, but going through a mock process to say, if we were being asked to sell today, what challenges do we know we would face? Because I'd say all buyers are going to want that same information. And that goes for financial statements and things too. Like, yeah, if you're 3 months behind, 6 months behind, that's going to be a concern. If the quality is not as good, obviously audits are helpful, but we understand not all businesses are going to require audits or need audits, but just to have gap-based financials if you can, or really just really clean financials. Every buyer is going to want to normalize earnings. And the cleaner your financials are, the easier that will be.
Chad, I've been involved a lot in corporate divestitures, but on this smaller family business side, what do you see with respect to warranties and future promises and estimates and that kind of thing?
That's where I think the terms of a transaction can be as important, if not more important than the price. And we always kind of focus on the price, but then you get in the battle of escrows and holdbacks and earnouts and all those things of a transaction. So, we do see that probably negotiated as hard, if not harder than the price sometimes, to say, first of all, we need a true up time period so that if after 3 months we get in and your working capital isn't what you said it was, or we find these deficiencies in the reps and warranties, we're taking back some of that holdup. So in a $10 million deal, maybe there's $2 million in a escrow that the buyer can get back if promises made don't hold up. And I think that's what you mean, Anita. But yeah, I think we see anything from significant dollars to maybe the seller is able to negotiate that number to be much lower. But I think it maybe sometimes has to do with risk inherent in a business, and if there's product or services they offer that there could be litigation around, or again, we see people argue about working capital probably as much or more than any other topic. So if receivables weren't collected in the way you hoped or whatever, is the buyer able to get some money back from that escrow?
Yeah, I would think in this current environment, that's probably even more critical, right? Yeah.
Yeah, especially receivables, and maybe lack of revenue and those kind of things. But if you historically receive 95% or 98% of your receivables, what's that look like over the next 3 months, 6 months? Hopefully you're making those estimates when you do the deal, but I agree, that's a good point, that that could be more important than ever.
Thank you.
Sometimes the management team is a critical piece to what the organization is wanting to buy or the new buyer really wants. But I certainly would have seen where there are struggles around the management team, the key players really wanting to stay because things are changing so much. So do you have particular hints around how to continuity with respect to the management team and so on with respect to the organization?
Yeah, hopefully the buyer is going to maintain a similar culture, give opportunities for the management team. But you're right. I mean, the risk is a lot of them decide to chase other opportunities. I do see sometimes stay bonuses can be part of it if you stay through 6 months or a year. So it's not even a performance bonus. It's if you're employed 6 months or a year after the transaction date, you'll receive some kind of stay bonus. So there are incentives you can generate, but long term, you just hope the culture is there and there's opportunity for management team to kind of get excited about and align to. Hopefully, you're not having to bribe them or bonus them to stay, but it is certainly a risk. Did you have any other thoughts on that, or have you seen things that work well?
To the most part, what I've really seen is retention bonuses and those kinds of things, which, as you say, that lasts for a while, but it certainly doesn't create the excitement and the commitment that you really need for a long term. And like you say, I think the environment is you have to be developing a company and the growth opportunities and so on that really people see as consistent with where they want their future to be. And money really doesn't do a long term.
Yeah, and hopefully as part of the seller due diligence, that's part of it, right? Are these people good people? What are their past record? What does their past look like in terms of acquisitions they've made? Have the sometimes we'll see sellers do that due diligence to call other owners. Did they treat you well? Did they treat your employees well? And that can be part of it. And maybe you have to walk away from a deal that looks very good otherwise. I guess we didn't mention the fact that, you know, you can look at stock options or other equity incentives to keep people tied to the business that way too. But hopefully they're excited about the culture and the direction the company's going.
This is Steve McConnelly. I'm had dialed in several years ago. I was in the corporate development group for Wells Fargo when we were doing a lot of acquisitions. And I can tell you from a buyer's perspective, we were always kind of disappointed when some key employees became independently wealthy upon closing of a transaction. And they were essential in transition. So as people are setting up maybe stay bonuses, I think the timing of those payments, and like you said, equity is a wonderful thing because then everybody's pulling on the rope in the same direction. But you know, if we had a head cashier at a bank or a treasurer or something like that, we needed them. And all of a sudden they got, you know, 4 times their annual salary from this community bank that we purchased. That was problematic. So I think structuring that can be really important in managing their expectations so that they know that, yeah, let's get this done and let's make sure it's transitioned well, and then they're independently wealthy.
Yeah, good point, Steve. Maybe that's too much incentive and they go and open up their own shop or some other passion they want to pursue.
Any other questions? Time is it's about 1:45. We do have some time for additional questions or thoughts.
You know, Andrea, we were talking before the call about family businesses, and I just a couple of unique dynamics with family businesses. You know, we talk about why this is a hard process, but choosing successor leaders amongst siblings or cousins, or I mean, it's a very difficult task. And so to have some kind of formality around that, to have development in place to sharpen the skill sets of those family members. We always find that family members coming in the business know the business really well. They know whether that's, you know, if it's construction business, they're actually out in the field. What they maybe don't know sometimes as much as the governance stuff. So, you know, working with the corporate attorney or dealing with financial statements or just some of the things that are now on your plate as a business owner. And, you know, so if there's any development that you can do years ahead of time with family members, you know, are at some point going to be in a leadership position, that helps quite a bit as well.
Yeah, you know, I think we run into the owner wants someone in the family to take it, right? And then it comes the time that no one in the family is really interested in taking the helm, or the company's become such a large animal that maybe they're interested in running maybe the business development portion of it, but don't necessarily want to control the entire company. So then the owner has to pivot and look at, well, then how can I get my children what I was hoping to get them, but yet still have an ownership structure that helps the company continue for all the rest of the employees. So I think that's been probably the bigger challenge that we're running into at this time.
I think that employee piece is really interesting. So typically how much notice does an employee get that the company is sold? It's got to come as a surprise oftentimes, I would think.
Yeah, for my part, I think they try to do that as late in the game as they can. I know we talked about how the pandemic is changing things. Some deals are getting stretched out a long time, and it's almost impossible to keep them in the dark. And so maybe an announcement comes out that we are in a process right now with this other party, and but it's difficult. I don't know if
Yeah, I think I can tell you, having been on both sides, I was an investment banker within Wells for several years, and then having been on the buy side, you know, key people will find out at least while, generally speaking, while the investment banker is brought in, and as you're preparing the diligence. But as far as rank and file employees go, I was always a fan of not telling people anything until you know it, and you don't know it. I mean, a letter of intent is non-binding, so it's really kind of once the deal is there, that's when you know you have a deal. Up until that point, you really don't. You think you might, but you know, you just don't even know how it's going to end. So you tend to not tell people for their own benefit, mostly.
With the fear that, yeah, you tell them after an LOI, it doesn't go through, and now you have egg on your face, or you have upset employees, or yeah.
They're reacting to something that hasn't happened yet, in either a good way or a bad way, and either way, it can be a problem. So yeah, we would always, on the buy side, just not tell people until, and I have walked into due diligences where the day we got there, they had announced to every employee that they were being sold, and it was like a bomb had gone off, and I'm like, no, this will be okay. You'll all have jobs. We're okay. We're not, you know, but it was still hard. So I've seen where that's handled a different way, and I think it's better to just wait until you know what you know.
Yeah, Steve, I would echo that. I've been in a situation where an LOI and the deal fell through just literally hours before the completion of it. And it would be really embarrassing, right, to have to, you know, share that information if the staff and the employees already know where you've been.
The other side to that is the fact that certainly some of the employees could be very helpful in some of the planning around the transition and sale. For example, technology, thinking about how do we move this forward from a technology perspective, or some of the tax planning initiatives or possibilities there, or you know, some of the you may be able to have a better deal overall if you really have the expertise involved. But I certainly understand why you wouldn't want to also. So there's really kind of a tightrope to walk between getting the information you need and you know, being able to move forward with that and keeping it quiet, because it could fall apart at any point in time as well.
Yeah, and I've always found that letting the key employees talk to the buyer, it's their chance to make their first good impression. So you don't want to deprive them of that either. So I think you're right. It not only can help the value and the terms of the deal, but it helps those employees that are key and the thought leaders in the business. Yes, they absolutely should be. And the buyers very often insist on it, because at the end of the day, the entrepreneur is probably going some other way.
Yeah, it's really hard for that business owner to get some of the financial stuff if they can't tell their CFO or controller or whatever. So yeah, it's a good point. You gotta weigh that.
Any final thoughts from anyone? I do want to let you know we'll share the slide deck back to you guys. So I will get that out. It'll have, the email will have contact for Chad and Becca. So if you have any questions that didn't get answered, or you want more in-depth information, Eide is happy to provide that. And then I want to just mention a couple upcoming events. So next week we have a new member networking event. So if you're relatively new or you're a prospective member, join us for that. And then the week after, we're going to do some women's networking. So we hope everybody will join us for that. And then we also have an event in June. The economist from PNC is going to be joining us, Stu Hoffman. And he has spoken at our chapter before, and he's very dynamic and will do a great job of kind of painting what the landscape looks like right now. So that's June 19th. So I will include a link to all the upcoming events so you guys can see those and join us if you like. Chad or Becca, any final thoughts before we sign off and we all get on with our day?
Just thanks for having us. I always enjoy talking about exit planning, and I think the battle is just the commitment to the process and the importance of it, and you know, getting some help from. Obviously, there's a role for, like I said, an attorney, an accountant, but the management team for that business owner to have somebody on their management team that they can look to help them navigate is very important. So appreciate being able to talk about it today.
Yeah, thank you for the partnership. We appreciate Eide Bailly. All right, thank you everyone. Have a great day.
This has
Thank you.
been really helpful, so thank you so much. Really appreciate it.
Thanks for comments.
you.
Thank you, guys.
Thank you.
Thanks everyone.
Thanks,
Bye.
Chad.
Bye-bye.
Bye guys.
Bye, everyone.
Yeah, bye Anita.
Bye.
Thanks, Roseanne. Really appreciate
Thank
it.
you so much. Yeah, it was great to
Yeah.
see you guys.
Yeah, no, this was good group, good conversation.
Good. Yeah, I thought so too. Yeah,
Yeah.
this is an interesting subject too. So
Yeah, good deal.
yeah. All right, we'll talk to you soon.
Thanks. Yep, have a good one.
Thanks.
Bye, Becca.
Bye.
Bye.